Benoît Mandelbrot, The Misbehavior of Markets, A Fractal View of Financial Turbulence. Welcome to a fascinating journey through the world of financial markets, as explored in Benoît Mandelbrot's The Misbehavior of Markets, A Fractal View of Financial Turbulence. In this book summary, you'll discover how traditional economic theories, based on assumptions of rationality and smooth transitions, fall short in capturing the true nature of market behavior. Instead, Mandelbrot proposes the use of fractal geometry, a mathematical approach that embraces the inherent roughness and complexity of markets. Key topics covered include the limitations of orthodox financial theories, the power of fractal geometry, and its successful application in contemporary trading strategies. Just as nature shows complex patterns, so do the financial markets, and a better understanding of these patterns can lead to more accurate predictions and investment decisions.
The myth of rational investing. The concept of homo economicus, the idea that investors behave rationally to maximize their utility, has been a mainstay in finance for over a century. Mainstream theories of finance assert that investors will always choose the most profitable, obvious rational choice. However, research has shown that investors often behave irrationally due to their tendency to misinterpret information and misjudge probabilities. This means that investors need to acknowledge their irrational behavior to make better investment decisions. Economic theories and investment strategies. The book challenges mainstream economic theories of finance, stating that they are based on oversimplified assumptions about human behavior. It critically evaluates the Chicago School's neoclassical theories, which assume that all investors have the same goal of making as much money as possible and hold their stocks for the same period. In reality, investors have different investment goals, time horizons, and follow vastly different strategies. Some are growth investors who buy stocks in companies that are experiencing rapid growth, while others prefer investing in mature and stable companies with slow but steady growth. The author questions whether mainstream economic theories, based on oversimplified assumptions, create bad predictions about market behavior, leading to poor investment choices. The flaws in orthodox financial theory. According to orthodox financial theory, prices are assumed to follow a normal distribution pattern where small price changes are much more frequent than large ones. However, this assumption is flawed. Prices do jump, and this phenomenon cannot be explained by normal distribution. One reason for this is that currency brokers tend to round decimal values, which results in overestimating the magnitude of a jump. Additionally, order imbalances, caused by situations such as large amounts of buy orders with few sellers, can lead to sudden price spikes. Big news, such as the FDA's approval of a new drug, can also cause hordes of people to rush and buy a particular stock, leading to a large price jump. In conclusion, orthodox financial theory is rooted in flawed assumptions, and there is a need to develop alternative models that can better explain the complexities of the market. The foundation of modern financial theory. Louis Bachelier's probabilistic model presented in his doctoral thesis at the Sorbonne would ultimately become the foundation of modern financial theory. His theory contradicted the idea that prices move in predictable patterns and suggested that they move randomly and independently. However, several empirical studies have shown that prices do follow trends, which can be caused by major news leaks or other factors. Campbell Harvey's study found that stocks that rose over a 5-year period are more likely to fall in the next 5 years. Thus, the mainstream theories of finance are unconvincing, and economic development needs a better and more precise description. Embracing the roughness. In the past, scientists considered irregularities as exceptions to smooth shapes or graphs. However, many natural and market processes are inherently rough, not smooth. Mainstream financial theories strive to impose smoothness on market dynamics, but they can't match up to reality. Theories that accept the market's roughness are more accurate and helpful. Fractal geometry, a unique kind of regularity that exhibits self-similarity, provides a solution for managing the roughness. Fractals are found not only in vegetables like Romanesco broccoli but also in wind turbulence and financial market behavior. By embracing the roughness, we can better understand and manage complex and seemingly chaotic phenomena. Making sense of the roughness in the cotton market. The conventional bachelor's model could not accommodate the rough nature of the cotton market due to the large variance in price surges and plunges. However, fractal geometry offers a solution to this problem by employing the concept of power laws. Power laws help us understand statistical relations and share the self-similarity property with fractal patterns, called scale invariance. This phenomenon means that at any magnification of an object, there's a smaller piece of the object that's similar to the whole. By using fractal geometry, we can make sense of the roughness of the cotton market and plot log-log diagrams that show similar curves for data sets taken from different time periods. Understanding time in market behavior. Clock time is not sufficient to understand market behavior as it does not account for the uneven distribution of information. Instead, using trading time to define intervals by amounts of information can reveal patterns in market behavior. Fractal analysis applies to any scale, and proportion of price changes remains the same. The intervals, defined irrespective of time, can distort time to enable financial analysts to deal with the roughness of markets. Thus, trading time is a useful tool to navigate the complexity of the market. Fractal geometry in economics. Fractal geometry challenges the standard theories of finance we know today. While no comprehensive economic theory based on fractal mathematics exists, several businesses are using this model. Oanda, a financial provider, uses fractal analysis for its online currency conversion platform and information on Forex. Capital Fund Management, France's largest hedge fund firm, also employs multifractal analysis for risk control and option pricing. In 2003, Oanda's net capital more than doubled, and in 2002, Capital Fund Management's largest fund reported stock market gains of 28.1% in a market that had fallen by a third. By using mathematical techniques derived from fractal analysis, fractal geometry has a place in the current understanding of economics. The next step is to develop these models into comprehensive economic theories.
In the end, the misbehavior of markets offers a compelling argument for the use of fractal geometry in understanding the complex dynamics of financial markets. It defies long-held beliefs about rational investors and smooth market transitions, highlighting the discrepancies in traditional economic theories. Not only does fractal geometry make sense of the roughness and irregularities in market behavior, but its applications can also lead to more effective trading strategies and better risk management. This book's summary has shown you that incorporating fractals into economic theory can help create more accurate predictions and better comprehend the true nature of financial turbulence. From a practical standpoint, businesses like Oanda and Capital Fund Management exemplify the benefits of using fractal analysis for improved profits and risk control. In a world of turbulent markets, embracing this new approach offers a way to better navigate the ever-changing tides of finance.